Hey everyone, in today's video, I'm going to be talking about three Canadian bank stocks that I currently own across my portfolios. I'm going to go into their current stock charts, their earnings estimates, some background on each of these companies, and why they're the three Canadian bank stocks that I decide to own in my portfolio. And then at the end of the video, I'm going to talk about five other Canadian financial stocks, just touching on them each quickly that I don't own, but just giving my high level thoughts on them. So going to jump right into this, but if you like this kind of content, be sure to give this video a big thumbs up. It really does help with the YouTube algorithm. Going into stock number one, it is CIBC, Canadian Imperial Bank of Commerce. This is the most Canadian bank out of the big five banks. They have a huge Canadian mortgage book and they have a really big Canadian loan book as well. They do have some wealth management and other businesses outside of the country, but primarily CIBC is a Canadian bank. They're also one of the smaller banks out of the big five banks. You see here market cap of $49 billion, currently paying a really nice 6.4% dividend yield. Over the last 5 years, like some of the other banks in Canada over the shorter term, this bank has been really stagnant, down 11% actually on the stock price, which is irregular if you look at these companies longer term. They've done a really good job of creating value. They generally go up over time, with their return on equity being significantly higher than their cost of capital. So let's go into this one a bit more. CIBC here, you just get a bit of a background on the company. Founded about 150 years ago, 13 million clients. They had net income in Q3 of about $1.5 billion, return on equity of about 11.5%, which is definitely on the lower side of what they do historical. Their TSR, they're quoting a 3-year TSR of 46%. So even though the stock price hasn't gone up, they've still been paying out dividends, doing other things for shareholders. Taking a look at what I was alluding to earlier with how Canadian this bank is, about 3/4 of their net income is coming from Canada here. Then 15% in the US, 13% other. So really heavy Canadian presence. In terms of by business unit, about a third is in Canadian personal and business banking. Lots of this, I think, is mortgages and stuff like that. A third is commercial and wealth management, and then a third is capital markets. They have a little tiny bit of US commercial and wealth management there. They've made a couple acquisitions, which is probably what that 5% is, but I think that's an area that they may try to grow out a bit more as well. Looking into their lending portfolio, just going to zoom in a bit here. You can see here over half of their lending portfolio is residential mortgages. So consumer is 62%. On that 62%, 51% is residential mortgages. Then on the business side, 11% commercial real estate, 25% business loans, 3% credit cards, auto lending, personal lending, and so on and so forth. So they have a pretty well diversified book here. Some consumer or some investors rather that are just concerned about the Canadian housing market think that this is a bit too much presence of mortgages in their loan book, but over time they've been pretty stable. Just talking about mortgages in general and the Canadian real estate sector. So that's one thing maybe to watch, but I'm not overly concerned on their exposure there. This is just going over their financial results over time. So you can kind of see net income, it sways a bit, and it's been a bit of volatility the last few years with interest rates, COVID, everything else. But give or take, they're making about $1.5 billion a quarter over the last few years. Their earnings per share has been around $1.50 to $2 a share, and revenue's been pretty stable here as well at about $5 billion to $6 billion a quarter. You can see here the return on equity was closer to, mid-teens over the last few years, dipped a bit here to 11.5%. So that's just one thing to keep an eye on. Looking at their valuation, so they're expected to do just under $7 both this year and next year. So looking at their stock price, they're trading at about 8 times forward earnings here at $54 a share. Now, with that being said, they do not have any growth forecasted on this company, just same EPS pretty much of about 690. So that may be one of the reasons why they're trading at a really low multiple. But at an 8 times multiple, paying me a 6.5% dividend and having the long term growth that they've been able to deliver over time, I think this is a good stock to have in my portfolio. I've had in my portfolio for a number of years. So looking forward to continuing to have this in my portfolio and maybe even building upon it if we do start breaking through the 52-week lows, which we're getting close to here. It's $53 and we're at 54. So that's the first Canadian bank stock I own in my portfolio. It is CIBC. Moving into the second bank stock I own in my portfolio, it is Bank of Nova Scotia, or Scotiabank. Similar dividend yield on this one. You're getting about a 6.5% yield, but the market cap on this one significantly bigger, from 50 billion on CIBC up to about 80 billion on this company here. Now, the main difference between CIBC and Scotiabank is just the geographical presence. In Scotiabank, you're getting a lot of Latin American exposure. They have operations in Mexico, Peru, Chile, Colombia, and they really have pushed acquisitions and stuff in that region to diversify away from just being a Canadian bank. Looking at a couple of their metrics here on their loan mix, when we thought that CIBC was a bit high on 51% residential, you can see Scotiabank here also very high on residential mortgages, over 60%. And then from a geographical mix perspective, you can see over here in terms of their international banking division, within international banking, it was about 3/4 Latin America. Now, looking at just their overall revenue up here, you can see that the Canadian banking is still about half of their business, so significantly lower than CIBC's, but still a good chunk of their business. They have a broader global presence, about 30% between wealth management and banking and markets, and then 23% is that international banking, which is dominated by Latin America exposure. So much more diversified geographically between global, Latin, and Canada, whereas CIBC was 3/4 Canada. Looking at this company's third quarter results here, quick, you can see their return on equity it went down as well to about 12.2%, so slightly ahead of CIBC's, but still over the long term, not great return on equities versus what these companies were doing previously, between 15 and 20%. They still pumped out pretty decent earnings per share of about $1.75, which was good to see. Made a couple $2 billion in the quarter. And if I just annualize that over the year, they're on track to be trading at about 9.5 to 10 times earnings. Now, looking at what their actual analyst expectations are, it's about $7 this year, $7.30 next year. So the company's trading at about 9 times next year's earnings, so slightly higher than CIBC at 8 times, but still pretty low valuations overall in the grand scheme of things here. Okay, going into the third Canadian bank stock that I own, and I've talked about this one before, so I'll try not to go into it too deep, but TD Bank, which is my biggest position in the Canadian bank. It's also my favorite Canadian bank stock. This one, while the other stocks have been actually down over the last 5 years, we looked at CIBC earlier, Scotiabank has a similar stock performance. TD's actually been up about 5%. I think TD's managed really well. They have only presence really in Canada and the US, and they're expanding in the north of the US and the northeast, or the east side of the US, down in the Carolinas and Florida, which I'll show you in a second. But this is just a really great run bank. They still pay a nice dividend yield, about 4.6%. They've been able to grow really nicely over time, and just their strategies and their risk management appear to be second to none, in my opinion, in the Canadian bank sector. Looking over the long term, you get a 4.6% starting dividend here. That's only about a 40 to 50% payout ratio. So they're really trading at about 10 times cash flows, and they're giving half of that to shareholders. But with the other half, they've been able to invest it in order to grow their profitability over time and accelerate EPS growth. So you can see here the dividend per share even if I looked 10 years ago, was less than half of what it is today at almost $4 a share. So over a 10% annualized growth CAGR on the dividend. So this is a high growth company, to be honest. If we look at the available of incremental cash and dividends they've been able to spin out year over year over year, and they've been paying out a dividend for 166 years. So I think that TD will probably be paying out and hopefully growing their dividend year over year until I'm no longer here in this position. Can continue just building and building into a huge cash cow. Looking at some of their rankings here. So when we think of TD Bank, we usually think of it as a Canadian bank. But if you look at it just on a North American lens, it's still one of the top banks by market cap, the fifth largest bank in North America, total assets, total deposits, et cetera, no matter what metric you want to go on. They're in the top 5 or 6 in North American banks and usually one of the top few in the Canadian market. So they have a ton of scale to make digital investments and really leverage those investments across a really big network in multiple countries. This is what I was just talking about. I've shown this in other videos, but you can kind of see their presence in the US here in the north and then down the east side of the country. That's really where they've been focused on. Even when they acquired First Horizon, lots of their presence was in this similar kind of area. I think it spanned in the central a bit, but it seems like for the most part they've stayed away from the west side of the US, whether that's competitive reasons or they don't think that side of the country is going to be growing as fast. But over 2,200 retail locations in North America. This is a really heavy retail bank, and I really like that element of TD because it's a lot less volatile than having 35% of net income from capital markets like CIBC has. They tend to have bigger fluctuations in EPS because of that. And then the revenue mix here, or the earnings mix rather, you can see over 30% coming from US retail banking, like that exposure there, almost 10% from their investment in Charles Schwab. That was through a merger with TD Ameritrade that they picked up some ownership in Charles Schwab, but they still own 40% Canadian banking, and then wealth management, wholesale banking kind of rounds it out. So I think this company has the best diversification business-wise. Scotiabank is giving me that Latin America and more geographical diversification, and then CIBC on the latter end is giving me, while not as much diversification, the lowest price to earnings ratio. So that's kind of my justification for having these three as my 3 Canadian bank stocks. Before jumping into additional financial stocks, just wanted to take a quick look at the EPS here. Look at TD here doing about $8.35 next year. So really trading around 10 times earnings. So as I look at the 3, I have CIBC trading at 8 times, Scotiabank trading at 9 times, TD Bank trading at 10 times. And I think that's fair for all 3 of them, given CIBC doesn't have as much diversification, has a big capital markets book, has a big mortgage book. Bank of Nova Scotia has had some challenges in their Latin American division, some provision for credit loss increases because of that. And then TD has really been a lot more solid than both of those banks, both in the short term, but also over the longer term. So I think it makes sense for them to be trading at a bit of a richer multiple. But all in all, between 8 and 10 times price to earnings for companies that have really grown very well and executed well to create shareholder value over the long term, have been increasing their dividends and paying dividends for like 100 years, and paying out dividends right now between 4.5% and 7%. I think just the sector at large is somewhat undervalued. So it's an area that I'm focused on continuing to average in throughout the year within my portfolio across any 3 of these names. I think are interesting opportunities for shareholders. Okay, so those are the 3 Canadian bank stocks that I own. I just wanted to go through some other Canadian bank stocks that I do not own, but I think is worth highlighting. So EQ Bank is a digital bank. I don't believe they have a footprint in terms of real estate or branches, but this is a really interesting bank. They offer really high GIC rates, savings rates, stuff like that. They're really a disruptor of a bank. And this company has been roaring up 50% so far in the last 1 year, even year to date here, up about 40%. They've been increasing their dividend almost on a quarterly basis as they continue to grow really fast. They bought a couple tuck-in acquisitions in the financial services space to accelerate their growth and provide some synergies. They just launched in the province of Quebec, so now I believe they're a national bank. And this is really primarily for younger consumers. I believe they have like a digital app and whatnot, but still trading here at about 8.5 times. So just a valuation in between CIBC and Scotiabank. They don't pay as much of a dividend because they're still investing lots of their profits in additional opportunities and scaling and getting bigger. So this is a bit more of a growth play, which is an interesting investment opportunity within the Canadian financial sector. Looking at their EPS, expected to do $10.50 this year and then $12 next year. So you can just see the growth of about 15-20%, significantly higher growth than any of the big developed Canadian banks that we were looking at prior. So at $12, if they actually pull that off, they'll be trading under 7 times next year's earnings. And that's probably why we've seen the stock just fly up as high as we have. The next stock here is Royal Bank of Canada. This is the biggest bank by market cap in Canada, most comparable to TD in terms of its standing and its presence in the Canadian market. Royal Bank has a lot more global exposure, I think. They have some business in the UK that they do. They have a huge global capital markets division, which once again adds a bit of volatility to the company relative to TD Bank that's more retail oriented. It also has the highest price to earnings ratio on it. So this one, if I look at what they're going to be doing in earnings, they're trading about 11 times both current and future earnings. So CIBC at 8, Scotiabank at 9, TD at 10, Royal Bank right now sitting at 11. So I think their earnings are more volatile and they're trading at a more expensive multiple. So I'm not overly interested and never have really been in Royal Bank. But similar to all the other banks, have done really well over time here, as you can kind of see their long-term stock chart up and to the right. The next bank stock or financial stock that I wanted to highlight here is Manulife. So Manulife, similar market cap to CIBC, trading at about a 9 times trailing PE, paying out almost a 6% dividend yield. Over the last 5 years, this one's been pretty flat. Looking at their EPS, they're expected to do actually some pretty nice growth, 330 to 360. So at 360 or at 330 this year, they're trading at about 7 to 7.5 times earnings. Manulife is obviously, for those of you who don't know, primarily an insurance company, has some business in the US through John Hancock, has some business in Japan as well, I believe. And they do some wealth management in addition to insurance. So personally, I feel like the banks like TD, for instance, has an insurance division. So I like having that playing a role in my financial stocks, but I don't think I need a stock that's wholly focused on insurance at large. So that's why I don't really have a pure play insurance provider or insurance stock rather, but I have stocks and banks that do have insurance divisions to get at least some exposure to that sector of the financial economy. The next stock here, very similar to Manulife, is Sunlife. This one trading a bit less at about $40 billion, but a higher price to earnings. So let's take a look at what is expected from them. Okay, they're expected to do about 687. So they're trading about 10 times earnings here. So they are trading at a premium to Manulife, who's trading closer to about 7.5. So I'm not exactly sure if Sunlife's been growing faster. If we look over the last year or 5 years here, we see them up 31%. Manulife is only up 8%. So maybe Sunlife has a bit more momentum behind them here. Still paying a really nice starting dividend of 4.5% here. So all of these companies, I think, have done really well over time. It's not too many you can pick that have gone wrong, but these in general have just not been ones I've been overly close to looking at because I think the banks are just more diversified in general. And then the last one here is Bank of Montreal, BMO, paying a 5% dividend yield, $84 billion market cap, similar price to earnings as Royal Bank. when I look at Bank of Montreal, I see a very similar strategy and bank as TD, where they have a big presence in Canada, expanding into the US. I think they have more business on the west side. They made a big acquisition, I believe, in California after COVID, with one of the banks that were operating there. So a bit different exposure in the US, but very similar playbook, it appears, to TD. And I just like TD's size more. I like their business more in terms of where they play and where they're getting their profits from. So I just feel like Bank of Montreal is too similar to TD to own both of them in my portfolio. But Bank of Montreal, like the rest of the stocks, have done pretty well. Taking a look over the last 5 years, up 9%. And then over the long term, similar to all the banks, doing really well. Even though you only see it up 9% over 5 years, just a couple percent a year, they have been probably paying this 5% dividend throughout. So despite the challenge with interest rates with COVID, you've probably been getting a high single-digit return over the last 5 years overall from holding a company like Bank of Montreal, which isn't bad given the time that we are going through. I think longer term, you can expect and potentially get even higher rates of return in the double digits. So those are some extra financial stocks that trade on the Canadian market that I just keep an eye on, and the reasons that I'm not necessarily invested in any of them. The three, just going back and wrapping up, the three that I am invested in, CIBC, Scotiabank, and TD, would be happy to add all three of them to my portfolio. High dividend yields between 4.5% and 6.5%. I think some of them getting closer to 7 or have gotten close to 7. Great entry point for the long term, in my opinion. I hope you guys got a lot of value out of this, got some financial stocks to add to your watch list, because I do feel like this space is a good opportunity for long-term investors with really nice starting yields and dividend growth over time. So if you like this video, be sure to give it a thumbs up. If you haven't subscribed to the channel yet, please be sure to hit that subscribe button, and I'll see you guys in the next one. Thanks.